Hello everyone, my name is Igor and today I will speak about project finance in Moldova and the main risks involved in this kind of transactions. So, what is project finance? Project finance is financing of long-term industrial projects based on a non-recourse or limited recourse basis, where the financing structure is highly leveraged, where the project debt is paid back from cash flow generated by the project company, with complex risk allocation between all project parties, and where the project debt is secured by all project assets, including revenue-producing contracts. What is the difference between a corporate lending, traditional, versus project finance? Well, corporate lending is based on the balance sheet of the borrower, based on historical financial information and performance of the company, and of course based on security over existing assets. Project finance lending is not based on this kind of historical financial information, but looks towards the future free cash flow projected to be generated by the project and relies heavily on a detailed due diligence of the project contracts to assess potential risks and to calculate projected costs and revenue over long periods of time, based on financial modeling to determine free cash flow during the term of the financing and whether the project is bankable at all. What is the basic structure of the project finance? Project company established is a special purpose vehicle which will build and operate the project. The shares in the SPV owned by the project sponsor joint venture agreements are between the sponsor and shareholders concluded, and of course with different obligations, management and voting rights. Bank syndicate enters into a loan agreement to finance the construction of the project. Bank's loans are repaid from the cash flow generated by the project after completion, and the repayment schedule may be between 7 to 15 years and sometimes longer. Project costs are financed by a combination of bank, debt and sponsor equity, subscription and subordinated debt, and typically has a ratio between 80 and 20. And project finance transactions are typically highly leveraged. What are the main project contracts? First of all is the construction contract EPC, known as turnkey contract, equipment supply contracts, offtake agreements, operating and maintenance agreements, concession or PPP agreements with the host government, land lease agreement, and interest hedge agreements. Also, insurance policies which are crucial for project finance bankability, environmental delay in startup and business interruption. Of course, direct agreements specific to project finance, which are tripartite agreements between SPV, project contractors and banks. The project contractors will not cancel their project contracts on default by the SPV if the banks perform their contracts. Independent expert engineers, insurance brokers, environmental experts who advise the banks. Project financing risks can be divided into 3 time frames in which the elements of credit exposure assume different characteristics. First, construction and development phase, startup phase, and operating phase, where the risks are decreasing. So, what are the main project risks? First of all, it is of the essence of every project that lawyers, experts identify these risks, price them, and mitigate. So, one of the risks is completion risk. The risk that the project will not be completed on time or at all because of technology failures, cost overruns, and force majeures. Permitting risk. The risk that official licenses and consents will not be available or not available at all. Important licenses will need to be obtained as a condition to founding, others may be milestones to future drawdowns requests. Price risk. The risk of volatile markets in respect to supplies to the project and sales by the project. This kind of risk will be mitigated by matching contracts and the pass-through of risk to the off-takers. Resource risk. Resource risk is the adequacy of different resources like minerals, gas, and these are mitigated by market reports. Operating risk. Operating cost risk is also mitigated by pass-through of extra costs to off-taker and retention accounts. Damage risk, covered by insurance, subject to deductibles, and will ensure any business interruption. Technology risk. Technology risk particularly relevant where there is an unproven, untested technology usually covered by expert evaluations. Environmental risk. Pollution costs which are mitigated by environmental expert reports, insurance, and clean-up retention accounts. Another risk is exchange rate risk, loan and costs revenue in different currency, which may be mitigated by the currency agreement to the extent possible. And interest rate risks will be mitigated by swaps. Political risk, which is very important for Moldova, will be mitigated by foreign government law for project documentation, subject to some exceptions, depends on real estate and security, and contractual sharing of political risk between sponsor and banks. Thank you. If you would like to know more about project finance, then please click the link below.